The Federal Reserve is raising interest rates for the first time since 2018. The move is intended to combat inflation by making borrowing more expensive. So let's bring in Yahoo finance correspondent Alexis Christoforous for more on that. Alexis, the Fed has been signaling that it might raise interest rates for months now.
Right.
So why now? Why this timing?
Well, this is the first interest rate hike from the Fed in more than 3 years, Diane. It was a quarter-point rate hike, largely expected, but the Fed also signaled here that they're going to get very aggressive. They've signaled 6 more rate hikes this year alone, and they're doing this because they're trying to slow the economy down and to take inflation a notch or two lower. We have inflation now at a 40-year high. You and I talked a lot on the show about the fact that we're paying more for just about everything: cars, food, housing, clothing, you name it. So they're trying to get inflation lower. Now, inflation was at about 8% last month. They want to get it down to 2% over the next 2 years. That's why they're going to get aggressive. But they're definitely walking a tightrope because they don't want to slow the economy so much that they tip us into recession. So what does this all mean for you and me? Basically, we're going to be paying more to borrow money. So rates on things like mortgage rates, credit cards, auto loans, even some student loans, they're going to see those rates move higher in the coming months.
So if mortgage rates are going higher, what does that mean for the housing market, for anyone trying to buy or sell a house?
Right, great question, because we know the housing market has been red hot. It's been a pillar of this economic recovery. And, you know, for years now, we've had interest rates near record lows, and we had low inventory and high demand. That pushed prices for homes at a record high. Do you know the median price now for a home in this country is over $357,000? It's so out of reach for folks, and it's about to get more expensive. I want to bring up the example that we have for you because we did some math, and if you have a $300,000 loan on a 30-year fixed mortgage at a mortgage rate of 4%, and that's where they've sort of been hanging around these past few weeks, your monthly payment is $1,472 a month. Now, if that rate goes up to 4.5%, your monthly payment, you see there, is $1,572 a month. That's a $131 increase monthly. Over the course of that loan, Diane, you're paying more than $47,000 for that home. So you're really going to start to feel these higher rates.
And so, is there anything we can do to protect ourselves?
There is, not much, but you can get a little proactive.
Okay, we can get.
All right, so if you have an adjustable rate mortgage, now might be the time to look to refinance and lock in a fixed mortgage so that as interest rates move higher during the year, you're not going to get hit with those higher rates. Credit card debt, right? If you have a lot of credit card debt, it's negotiable to some extent. Pay your credit card issuer a phone call and say, look, I want to negotiate the best rate I possibly can. And you can also look to consolidate all of that debt into one credit card with the most attractive interest rate you can find.
Is there any upside to all of this?
You know, there is. If you are looking to save money, you know, during the pandemic, we didn't go out and spend, so we were hoarding cash, and the savings rate in this country hit a record high. So if you're looking to save money, you're going to start to make a little bit more money. I have to share these very paltry numbers with you. Look at this. The average savings account right now, you know how much you're making? 0.06%. And if you're locking up your money for 1 year in a CD, you're making just 0.14%. So basically nothing at all. So those rates should start to move up incrementally, but they're going to start to go up as the year goes on.
And then this is, of course, all happening against the backdrop of soaring gas prices. It feels like every time we look at the numbers, they go higher and higher and higher. So is there an end in sight to that?
You know, I think as long as we have the uncertainty of the war in Ukraine, you're going to see elevated energy prices. These past few days, we've seen crude oil prices come down quite a bit. They were below $100 a barrel for a while, and that definitely impacts energy prices, except there's a lag. And once those crude oil prices come down, you don't necessarily see it right away at the gas pump. We should start to see a little bit of relief, and by that I mean just a few pennies on the gallon over the next week or so. But get ready for these high energy prices for quite some time.
All right. Alexis Christoforous, always great to have you, and great to finally have you here in person in studio.
Absolutely. Thanks, and happy St. Patrick's Day.
Thank you. Happy St. Patrick's Day to you. Love the green.
Hi, everyone. George Stephanopoulos here. Thanks for checking out the ABC News YouTube channel. If you'd like to get more videos, show highlights, and watch live event coverage, click on the right over here to subscribe to our channel. And don't forget to download the ABC News app for breaking news alerts. Thanks for watching.